Have you ever wondered if the meteoric rise of a new technology is a sign of a golden age, or the echo of a forgotten storm? In the grand theater of history, progress has always been a dramatic play, filled with breathtaking ascents and heart-wrenching falls. Today, as we stand in awe of artificial intelligence, a whisper from the past reminds us to look back, to learn from the art, ghosts of fortunes made and lost, and to understand the timeless rhythm of human hope and folly. This is a story not just of stocks and charts, but of dreams, delusions, and the enduring lessons forged in the fires of financial history. The stock market, in its long and storied existence, is a library of human ambition. Within its volumes, we find recurring tales of intense excitement for groundbreaking innovations, periods where collective belief inflates asset values into magnificent bubbles, only for them to burst with breathtaking speed. These episodes of irrational exuberance almost always follow a predictable script. A compelling new technology captures the public imagination. Prices detach from reality driven by crowd psychology, and a painful correction follows when the lofty promises fail to meet the harsh light of day. This pattern, this cycle of boom and bust, offers profound wisdom for our own times. To truly grasp the present, we must first journey back and walk through the ruins of two of history's most infamous speculative manias. Our first stop takes us to a time not so long ago, a period that feels startlingly familiar to our current fascination with AI, the dot-com bubble. This was the quintessential modern technology bubble, a whirlwind of optimism centered around a world-changing innovation, the internet. The saga began around 1996, but its fuse was truly lit with the explosive initial public offering IPO of Netscape in 1995. This single event didn't just launch a company, it launched an entire era, a gold rush, where the treasure was a domain name ending in .com. It was a time when the old rules of investing were cast aside, replaced by a single, intoxicating belief: the internet would change everything, and any company associated with it was destined for infinite growth. An almost religious fervor swept through the investment community, a classic case of FOMO, the fear of missing out. Investors, both seasoned and novice, abandoned caution and piled into technology stocks with reckless abandon. They weren't just buying shares, they were buying a piece of the future. It didn't matter if a company had never turned a profit or had no clear path to revenue. The presence of a .com in its name was enough to guarantee a blockbuster IPO and a stratospheric valuation on the NASDAQ exchange. Traditional metrics were deemed obsolete. Instead, a new, distorted logic took hold, where companies were valued not on their earnings, on their eyeballs or potential market share in a future that was still just a dream. This irrational valuation system created a chasm between stock prices and the actual, tangible performance of the businesses, stretching the market to a breaking point. The crescendo of this symphony of speculation came in March 2000. For a fleeting moment, it seemed the believers were right, that this time truly was different. But reality has a way of asserting itself. As the first quarter of the year drew to a close, financial institutions began to publish reports that laid bare the ugly truth. Many of these celebrated dot-com darlings were hemorrhaging cash, their losses astronomical. The spell was broken. The rush for the exits began as a trickle, then became a flood. The collapse was as swift and brutal as the ascent had been exhilarating. The NASDAQ index, the very symbol of the new economy, plummeted by more than 75% from its peak. Giants of the old tech guard like Cisco and Intel were not spared, losing over 80% of their market value. More than 400 dot-com companies, once hailed as the future, simply vanished, becoming footnotes in a cautionary tale. The lesson from the ashes was stark and unforgiving, a compelling narrative and a story of growth. No matter how seductive, can never be a substitute for fundamental value and real, sustainable profit. To find the second, and perhaps most foundational lesson, we must travel much further back in time, to the Netherlands in the 17th century. Here, we find a story that, while not about technology, has become the timeless metaphor for every speculative craze since. Tulip mania. At its peak in the winter of 1637, this episode demonstrated that the mechanics of a bubble are deeply rooted in human nature itself. In 17th century Holland, the tulip was not just a flower, it was an object of intense desire, a symbol of wealth, status, and novelty, much like a revolutionary technology, is viewed today. Rare and beautiful bulbs became the ultimate luxury good, and soon a vehicle for wild speculation. The frenzy began subtly but quickly spiraled into a nationwide obsession. People from all walks of life, from merchants to maids, were swept up in the dream of instant wealth. They traded their homes, their land, and their life savings for a single tulip bulb. Not for its beauty, but on the fervent belief that they could sell it to someone else for an even higher price. At the height of the mania, a single bulb of a rare variety could be traded for a sum equivalent to many times the annual income of a skilled craftsman. This speculative fever was fueled by what economists now call the greater fool theory. The idea that it's rational to buy an overpriced asset as long as you believe there's a greater fool out there willing to pay even more. For a time, this logic seemed to work, creating immense paper fortunes and a dizzying sense of prosperity. But like all bubbles, the tulip bubble was destined to pop. In February 1637, with no clear trigger, the market simply ran out of greater fools. A few sellers couldn't find buyers at the exorbitant prices, and panic set in. The confidence that had fueled the ascent evaporated overnight. Prices collapsed catastrophically, falling to a mere 1% of their peak value almost instantly. Fortunes that had been built on the delicate petals of a flower turned to dust, leaving behind a trail of financial ruin and shattered dreams. The lesson of tulip mania resonates through the centuries, when an asset's price is driven purely by speculation. In the hope of selling it to the next person, it is detached from any intrinsic value, and its eventual collapse is not a matter of if, but when. When we place these two historical events side by side, a powerful pattern emerges. In the dot-com bubble of the late 20th century, the assets were internet stocks. Fueled by FOMO and a messianic belief in a permanent change to the economy, the outcome was a more than 75% drop in the Nasdaq, erasing trillions in value. 3.5 centuries earlier, in the tulip mania of 1637, the assets were simple flower bulbs, fueled by pure greed and the greater fool theory. The outcome was a return to their simple material value, wiping out the speculative wealth that had been created. Though the technologies and the times change, the driving forces remain eerily constant. Experts and historians who study these phenomena continually stress one central point. Whether the catalyst is the dawn of the internet or the allure of an exotic flower, the true engine of every bubble is not found in the asset itself, but within the human heart. It is our own timeless emotions, the intoxicating pull of greed, the gnawing fear of being left behind, and the seductive overconfidence that whispers, "This time is different," that inflate these manias. History does not offer us a crystal ball to predict the future, but it does provide a mirror. By understanding these stories of past exuberance, we are better equipped to navigate the journeys of today, to separate true, lasting innovation from the fleeting madness of crowds, and to build a future not on the shifting sands of speculation, but on the solid ground of enduring value.